started. Okay. Well, folks, welcome to another Workshop Wednesday. I'm Jennifer Slatter with League of Cities and Towns, joined here by our Executive Director, Randy Rossi, um, and some other colleagues popping in the door here, CJ Donovan and Heidi Gelsomino as well. I'm looking at, we're joined today with our friends from Ernst & Young. I do have a quick request from the governor's office to make an announcement prior to getting started. So I will go ahead and ask whether that's Shay or Jeremy from the governor's office if they'd like to take themselves off mute and make whatever announcement you would like.
Jeremy. Oh, there he is. Okay, perfect.
Add the hourglass. Hey, just really quickly, thank you for so many of you who have participated so far in the Math Matters grant opportunity with the Rhode Island Department of Education through Municipal Leaders. And that application is due on Friday. And so I know many of you have submitted. I know many of you have been engaged and committed to submitting. But if you have any need for support, questions, comments, concerns, we're here to support you. And to take the money that's deserving for your community and invest it in math programming. So happy to take a question now or just remind you we're here for you. I'll put my contact in the chat again so you have it.
Perfect. Thank you, Jeremy. All right, well, we're going to turn it over to our friends from EY, who we're grateful for this relationship. We're happy that they have are a sponsor for our convention as well, so thank you for that. Today we're going to have them talk about tax credits and cash savings for cities and towns. So with that, I'll turn it over to Bob Lemmy and let you introduce the team. Thanks for being here, Bob.
Great. Thanks so much, Jen. And it's great to speak with everyone. And thank you all for your time today. And you've probably all heard something about the Inflation Reduction Act. It is something that came along in August of 2022, and it's been a very exciting opportunity financially for, for governmental organizations and a lot of nonprofits who are looking to help with financing components of their decarbonization initiatives and such. So we've got a great team assembled here today. I first want to just mention Brendan McCrory, who is also on the line here. Brendan and I head up the Rhode Island team. Brendan is actually based in Providence and has been working with the state for a long time. And we also, in addition to the state, we also support all the local municipalities as well within Rhode Island. And I want to hand it over to Jess and Shannon, who are on our credits and incentives team and are going to take you through some of the content that we have today.
Thanks, Bob. Good morning, everyone. Shannon and I serve different entities, local governments in the New England area, so we're very excited to be with you today. So just quickly, our agenda, we'll just go through an overview of some of the more applicable tax credits that might apply to cities and towns. We'll talk through direct pay, documentation requirements, such as the pre-filing registration, what's required for your tax return, prevailing wage and apprenticeship requirements, and domestic content. So I think the first thing is, what we're seeing in the market for local governments. This is a tax credit. Many of these credits have been around for a long time for for-profit entities, but as most of you are aware, the IRA made this direct pay option. So now these credits are accessible for state and local governments, hospital systems, different entities that weren't able to access tax credits previously. What we're seeing, the investments we're seeing that are more applicable, typically around solar, geothermal, energy storage technologies. We've seen like waste to energy systems in the wastewater space or around like landfills, potentially qualify for tax credits. In addition, purchases of electric vehicles and clean charging infrastructure. I think one of the big questions we're getting right now is like the status of these credits under the Trump administration. And right now, all the credits are still active. They're not a part of any of the freezes. Most of our clients in this space are still, trudging ahead with documenting and applying for these credits, since, all of these are subject to different IRS filing deadlines and they want to remain on track. I think the only thing that could potentially change, there has been some bills proposed around the vehicle and charging infrastructure credits, but it's only proposed right now. And what we've seen is, even current projects that are underway will likely still be eligible. And the current way those bills are written as any sunset would be 30 days after the bill passes, and would only apply to projects where you're not already under a binding written contract. So hopefully that's if that happens, any projects or investments that are underway would likely still qualify.
And Jess, just to jump in real quick, because I know a lot of people have been hearing about freezes that have been happening. That really has been mostly in that context of grants. And there are even grants under the Inflation Reduction Act that may be impacted as well. But we're really going to be talking about tax credits today. And tax credits are obviously part of the Internal Revenue Code. And any changes to tax credits has to go through Congress and become formal law after being passed in the Congress, and then obviously would go through the president as well. But it's a very different and much longer and involved process than what you're probably hearing about with grants. I just wanted to draw that distinction.
So a quick overview on direct pay. This applies to state and local governments, water districts, school districts, other political subdivisions. You have to make an election on your tax return to get the payment back, which is basically going to be like an overpayment of tax, and then you would receive a check in the mail. In order to make this election, there's a pre-filing registration required, which they recommend submitting with at least 120 days before the tax return. We understand a lot of local governments might not have filed tax returns before. So, the guidance is that typically it's going to go on a 990T. We'll get into a little bit more detail on that as we go on, but that's the basic overview of direct pay. The one thing is, you do want to have good documentation around this, because if there is a 20% penalty if you were to claim excessive amounts, and typically as long as you've done your due diligence and documented your credits, you wouldn't be subject to that type of penalty. So for what we're seeing, the tax credits that are most applicable to state and local government is Section 48 and Section 48E. This is going to be the investment tax credit for clean energy property. So solar, geothermal, energy storage, CHP. It's up to a 30% tax credit if you meet certain prevailing wage and apprenticeship requirements. And then there's certain bonus credits for being in an energy community or meeting domestic content. For Section 48, they're very prescribed technologies. This credit is available for projects that began construction before the end of the year, end of 2024, besides geothermal, which goes through 2035. Starting this year, projects that begin in 2025 are going to be under a new credit called Section 48E. This is a technology neutral credit. So instead of giving you a list, it's more around if the technology is clean energy and clean electricity, and there aren't greenhouse gas emissions. So it has similar requirements as Section 48, same up to 30% credit with PWA, and then bonus credits. I think the biggest distinction between Section 48 and 48E is the IRS put out a list of what's considered, clean energy certain systems like solar, geothermal, battery storage that continues to be eligible under 48E. Where there's a little bit more nuance going forward is with technology that's considered combustion or gasification. So that would be like combined heat and power, biogas, where there has to be some additional analysis done with it, greenhouse gas life cycle analysis. So a little bit more work to see if those types of technologies will meet the requirements. But geothermal, I think, is one of the geothermal, solar, some of the biggest of what we're seeing around, especially in the New England area. And this is just a quick overview. So as mentioned, could be up to a 50% credit. I think we're seeing more probably in the 30 to 40% range, but just a quick example of how this credit works. It's base credit of 6%. If you meet prevailing wage and apprenticeship requirements, up to 30, and then these additional adders based on meeting for bonus credits. The one thing we'll mention is, it's a lot of these projects are funded by tax exempt bonds. There is up to a 15% haircut on the actual credit at the end, but you can still use, that type of financing for these projects, or others, types of loans. You can still qualify for these credits. So the other credits we're seeing a lot of it. So Section 45W is for the purchase of electric trucks or passenger vehicles. The credit is up to $7,500 for smaller vehicles, up to $40,000 for heavier vehicles. It's going to be capped at the incremental cost from purchasing like a gasoline or diesel vehicle versus the electric. In the past couple of years, generally the price difference has been enough that organizations are able to max out the credits. And then the next one is 30C, which is the alternative fuel refueling property credit. This is for, charging stations, hydrogen fuel cell recharging stations. The credit is up to $100,000 per charger. It's a 30% credit if you meet PWA. The only thing about this credit is you have to install the property in a low-income community or a non-urban area. So it is a little bit more limited. They have mapping tools online where you can put in your address and see if your area would qualify under this. And then the IRS also lists out the actual census tracts. But you can, if the mapping site is pretty easy to access, and just kind of do a quick check to see if your area would meet one of those two qualifications. Next thing we'll just run through is documentation. That's the big thing about these credits, is just getting your documentation in place and working with your vendors or contractors so they can start collecting everything up front, so you're not having to chase all this down at the end of the project. So, there's certain documentation required for the pre-filing registration and the tax forms. If you want to meet any of the bonus credits. And then typically you also want to make sure to document like when you began construction, because a lot of the credits are based on begin construction date and then place in service date, because that'll be the year where you actually take the credit on your return. And then just keeping track of all the costs you spend that would go to generate the credit. So next, I'll just go into the pre-filing registration process. This is where we've seen a lot of our, state and local government clients needing, some additional help, because this is a new process that most of us haven't done before. So in order to claim this as direct pay, as I mentioned, you have to pre-register, and then they're going to give you a number that you put on your return. Main reason for this process is just to avoid fraud. So they want to make sure that the project actually exists. So when you put this number on your return, it'll be a quicker process for them to process your refund. So there's a pre-registration site. The IRS has put out some good guidance that has a lot of screenshots. The suggestion is to submit your pre-registration at least 120 days before the return is due. To do this, you have to create an ID.me account through the IRS system, and then have a clean energy account. In order to do this, to start the clean energy account, you have to have an EIN or TIN for your government or organization. If you don't have that, you can request that through the IRS. I think the big thing we're hearing is to make sure when you create your energy account that you add a delegate, because we are hearing a lot of people leaving the organization who had the account, and then it just gets to be a bit of a pain to get that swapped out. And usually time is of the essence when you're going through this registration. So you'll make the registration, you would initiate a new registration for each tax year, and then you can add each individual property. So if you have like 10 electric vehicles for the year, you'd have to do 10 registrations underneath your account. It's fairly basic information they ask for, but I think the biggest thing is they just want to make sure that you own the property. And so like for the vehicle credits, they'll ask for like the registration or title. For like geothermal or solar, they're going to want to see that some form of documentation that shows that you own the property, that you started the project, and then you put the project into service. So what we've seen there that's worked is, if you have a general contractor, we've taken some pages from the contract that showed like the relationship of you hiring the contract and you ultimately taking ownership of that property at the end of the project, or it could be a purchase and sale agreement. I think it's all they just want to make sure that you're the owner and they can tie that project to you. And then typically they want to see that you began construction, which could be permitting, or like for geothermal, we've seen like reports that daily logs of well drilling, and then placed in service could be, your certificate of completion, or if you have to connect into the utility, some kind of approval from the utility that you're ready to, connect to the grid. So that gets submitted as a pre-registration. The IRS reviews it. If they have any questions, they might come back. And then assuming everything's okay, they'll give you that pre-registration number, and then that's what goes on the return. What I've noticed with the IRS is they have been pretty helpful navigating this pre-registration tool. They have like secure messaging within the account that's been helpful. They also have office hours that are right now like twice a month, where if you have questions, they'll answer them. They won't give you, you don't reveal your personal information, but I think they know who you are. So if they can't answer it on the phone, they have said they'd reach out to you directly. They also have an email address where if you're very close to your filing deadline and your pre-registration number hasn't been issued yet, that they'll help to try to get that done before your return is filed. So I found them to be very, very helpful. One of my clients didn't get their pre-registration in until I think 45 days before the return was due, and they submitted it incorrectly, and we were able to troubleshoot that and get it on the return. So generally they've been pretty helpful to make sure you can get your number, but we do recommend you do it as early as possible, just so you don't have to, worry.
Just to jump in again, I know many of you, if not all of you, may be sitting there also thinking, we haven't filed tax returns. We're not required to file tax returns as a municipality and as a state. So there, and I think Jess is going to be covering this some more, but just wanted to kind of acknowledge that. And that's certainly something that we help with as well. If this may be a first time that you're doing any type of filing like this. And I think another important thing too is because the place and service date is really what triggers the whole pre-registration process and ultimately the filing. There is a lag in between from a financing standpoint, and that is another thing that we could potentially help with is looking at potential financing options that would be available within the state of Rhode Island if that was also something that sounds like it may be a challenge. So thanks, Jess.
Yeah, good point, Bob. Yeah, so I think most organizations are going to be filing a 990T to claim this credit. They just recently updated their Form 8868 to allow you to apply for a 6-month extension, so you have a little bit more time to get everything pulled together. If you're only filing the 990T to make the elective payment and you have no unrelated business income, you are only filling out a very abbreviated portion of the 990T, and the form instructions are pretty clear about which sections you have to fill out. So it's not too big of a lift. And then in addition to the 990T, there are credit forms you have to attach, which the 3800, and then each credit will have its own source form. And I would just not leave that to the last minute, because the forms, it's basically gonna ask you all about your credit, but there are like different pieces you have to fill out, and then some of them might require a statement attached, like attesting to either when you started construction or other things that you know, someone's gonna have to sign, so you just want to give yourself enough time to get everything pulled together for the package. For applicable entities, you can paper file unless you're under Section 511, but electronic filing is strongly encouraged, and it'll speed up your processing of your refund. The feedback we've gotten from the IRS is for filers from 11/15 is that the refunds that aren't coming through yet are ones with paper filing, because it just requires a lot more attention on their side. And I think, you know, if you go down the electronic filing route, I just make sure whatever tax software or provider you use has the source credit forms, because we have seen some software not have that. And then when you try to e-file, it'll just get rejected, which kind of defeats your whole purpose of going through the electronic filing process. So it's just something you want to make sure if you hire or get software that they have the necessary tax credit forms along with the 990T. I'll have Shannon's going to talk through some of the bonus credits and just what we're seeing, you know, any challenges around that and some of the documentation we recommend.
Everyone. So as just mentioned before, if a company meets prevailing wage and apprenticeship requirements, your base credit could go from 6% to 30%. And that's specifically for the investment tax credits under Section 48 and 48E, or increased deductions for Section 179D. So ultimately, prevailing wages must be paid for any labor or mechanic that's involved in the project through construction, alterations, or repairs. These prevailing wages are determined by the Department of Labor and are based on factors such as job title, location, years of experience, start date, contract length, and even if applicable, fringe benefits. For the apprenticeship side, there is a minimum requirement, a minimum percentage requirement of total labor hours that must be performed by qualified apprentices. You'll see on the slide here, the percentages vary based on the start date of construction. So that's why Jess was mentioning it's very important to understand when you begin construction, because it will matter. And then the general rule of thumb for the apprenticeship requirement is that for each contractor or subcontractor who employs 4 or more construction, alteration, or repair workers, there must be at least one from a qualified apprentice. And then one last thing we'll touch on, which I know we'll also touch on like other areas here. There is one exception there for section 48 and 48E that if you have property less than 1 megawatt, you will be excluded from the prevailing wage requirement. So to continue with prevailing wage requirements, all taxpayers must pay the correct prevailing wage for the geography and trade based on the SAM.gov, as well as maintain sufficient records. So SAM.gov is the website used by the US government to check compliance for these prevailing wages. Now, if the wage is not listed on the website, which we have experienced with a few clients before, you must contact the Wage and Hour Division at the Department of Labor via email for confirmation on which prevailing wage you should use. A couple of other few important notes to keep in mind that we've seen asked by our clients is whether the characterization of employee or independent contractors is relevant, which we can confirm. It is not. Prevailing wage would have to be met for both. And then the bona fide fringe benefits should be included in wages. So something to just make sure that you're keeping track of. And then last of all, very important to know when prevailing wage are locked in. So this can be from the time you begin construction, or it can be from the time the contract is executed. The contract is executed if the taxpayer hires a contractor, or at the time the work commences if the taxpayer is self-performing the construction.
Yeah, and I would say the only thing I would add here is I think for, New England, meeting prevailing wage is probably not as big of an issue because we have higher wage rates. So it's more going to probably be documenting, having certified payroll in your records to make sure you've met these and, making sure that in most cases we've seen this in New England, the state rate is often higher, but you do just want to check this to make sure there's no issue.
So to switch back to the apprenticeship requirement, there are 3 tests that need to be met: the labor hours, the ratio, and the participation requirements. So as I mentioned before, the labor hour percentages will vary based on the year construction begins. So if your project starts in 2023, you'll need 12.5% of all hours to be from apprentices. And then all projects beginning in 2024 or later will be required to have 15%. For the ratio test, the relevant journey worker to apprentice ratio must be met on a daily basis. It's really important, and I know a number of our clients have asked this. It's definitely on a daily basis, and if it's not met, you must then pay the excess apprentice's full prevailing wage, and the excess apprenticeship hours will not be able to count towards your labor hour requirement. And then the last test is going to be that participation test, which again, if your contractor or subcontractor employs 4 or more different laborers at a time, and it does not matter on the project location, they must have at least 1 apprenticeship from there.
With this participation requirement, the apprentice doesn't necessarily have to be on site every day that the contractor's there, but they have to participate at least at some point during the project. And so Shannon will go through some of the just cure provisions at very high level. I think the IRA does allow for like a way to cure. So, if for some reason someone wasn't paid prevailing wage, or one of your contractors wasn't able to get an apprentice, or there are some ways to still, to cure and still meet that, to still get that 30% credit.
Yes, so as Jess mentioned, there are penalties associated with not paying prevailing wage. That's going to be $5,000 per laborer. The earliest you'd pay that penalty is on the return, but as Jess just mentioned, you are able to make correction payments prior to that to limit any interest that's due. We typically tell our clients to review prevailing wages at least quarterly to be able to make these correction payments and to avoid intentional disregard. Now, intentional disregard, if it is deemed, it's going to be a much higher penalty. It actually jumps from, is it actually, okay, sorry, just lost my spot here. So it's important to keep these records. It also sounds crazy, but we have had a few instances where you can't locate a laborer. Even if you can't locate the laborer, you still have to correct that wage variance. From what we've seen, most taxpayers will likely pay a penalty at some point, but if the proper procedures are put in place up front, you'll be able to minimize these penalties as best as possible. Something to keep in mind, it may be worth incorporating in your contracts and subcontractor agreements language that requires the contractor and subcontractor to keep and maintain these records, because you will be like it's one thing if the subcontractor or contractor is providing you wrong information, but it is something that you'll be penalized if it's not updated. So it's very, very important to maintain the records and just continuously record over quarterly, or even if, depending on the number of subcontractors or contractors, monthly. But definitely something to keep in mind when you're going through these procedures. So as Jess mentioned, you can get around this. So actually, yeah, it probably makes sense to jump into the penalties with apprenticeship first. So the penalty for not meeting the apprenticeship requirements is $50 multiplied by the total labor hours not meeting the required apprenticeship requirements under the labor hours and participation requirements. If it's deemed intentional disregard, that's going to shift from 50 to 500, which is pretty significant. If both tests are failed, the penalty is based on the sum of the labor hours, which both tests are not being met. And then
The one thing,
oh, go ahead, Jeff.
I think the biggest thing we're hearing about apprentices is there aren't enough apprentices to satisfy all these projects. So like the biggest recommendation we have around this is just to, a lot of it is going to be more of a documentation exercise, and Shannon will go through this good faith exception, but this good faith exception is what we see a lot of clients rely on just because there aren't enough apprentices. And like for geothermal, for example, there aren't programs that have everywhere that have the apprentices you need. So to get around, not have to pay these penalties, they do give you, there is some relief under this good faith exception. Shannon, if you want to walk through that.
Yes, so in order to receive this exception, a request must be made 45 days to the start date of the services, to a registered apprenticeship program for each labor classification. If a request is not responded to or denied within like 5 business days, the good faith exception would apply. It's not always the case, but it's important that a taxpayer, contractor, or subcontractor try to request, if available, more than one apprenticeship program. It's really just, again, the good faith effort is really about documentation. So you will need to provide proof that you did reach out, you tried to get bids. If there were denials or like you had cost differentials or more favorable, like you could provide that documentation. It's just very important to show the effort that you did go forward, because it could be seen as intentional disregard if you do not show any attempt at going at an apprentice.
I think that, yeah, and I think the other big thing with good faith exception is so you have, when you make the request, you need to put in like the time period, the number of apprentices, the trade, and the hours. If you get back, they don't respond or they don't have anyone available, whatever hours you put on that good faith request and that request, you can count those hours towards your 15% requirement, even if you didn't get an apprentice. So it's very important to at least make the request and have that documentation lined up, because if you're below, that can help you get to that 15% apprenticeship hours, even if you can't get an apprentice, which we are seeing a lot. So, it's all about making sure you're set up front to try to get all this documentation and just keeping the records.
Okay, so as Jess mentioned before, there is a phased domestic content requirement for certain credits that take the direct pay. It's important to know that certain credits, including Section 48 and 48E, there is a requirement for qualified projects electing the direct pay option that begin construction in 2024 or later to meet the domestic content requirement. You'll see below in this grid, like we have pretty much the direct payment amounts could be reduced or phased out if domestic content requirements are not achieved. And then ultimately, it's important to, again, just hone in on the fact that when your construction starts, because it does impact all of these percentages. So it's something to just keep in mind when you're going forward with these types of projects. We're going to go into more detail on the requirement itself, but this is the breakout below just so you can have an idea.
Yeah, and I think the big thing with this is if it's a smaller system, which we have seen, if you're putting geothermal with a school, it might, or you're just doing a smaller solar system, it might, if you are under a megawatt and they have a conversion for thermal energy, of what that would be, then you would be exempt from this requirement. So it is something to check up front, to see if you meet that requirement, so you don't have to worry about documenting all this unless you are planning to source domestically anyway.
And just to emphasize a point, domestic content essentially means made in America. So obviously there's trying to encourage the manufacturing to happen here in the US.
Perfect segue, Bob. So the domestic content bonus credit is available to taxpayers that certify their project was built with certain percentages of steel, iron, or manufactured products that were mined, produced, or manufactured in the US. Now, there are certain areas that are considered like structural, as others are not. So pretty much items such as like nuts, bolts, screws, washers, clamps, all of these, even though they're made primarily of steel and iron, they're not going to be considered structural in function. Structural is mostly going to be, if you were to take that piece out of the equipment or product, would it fall apart? Would it be able to work? And then there's the other side of it where it's the manufactured product. And for that to be considered produced in the US, all the manufacturing processes for the manufactured product have to take place in the US, and all the manufactured product components of the manufactured product are of US origin. So just to clarify here too, if it's manufactured in the US, regardless of the origin of its subcomponents, it still can count. Now, we've seen that there's been a number of issues with companies trying to comply with the domestic content, because companies are having issues receiving the information from their suppliers. As a way to move around this, you could use the adjusted percentage rule, which is determined by dividing the domestic manufactured products and components cost by the total manufactured products cost. So the adjusted percentage rule is met if the domestic cost percentage for an applicable project equals or exceeds the applicable adjusted percentage. And you'll see below in the percentages, again, this varies based on the construction beginning year. It's also important to know that typically these costs are going to be direct costs, which is direct materials and labor costs. One thing to keep in mind, and something that we've been seeing in the market, as I said, it's been hard for some of these clients to get information from their suppliers. We have seen a way to move around this where some contractors will have you sign an NDA, or they'll only have certain employees have access that may be outside of procurement. That way they're not seeing the total numbers that are going into maybe like the markup compared to what they're paying. But there's also another way of looking at this where many companies, if they're not able to get the breakdown of data, they'll look at the total cost versus the direct cost as a more conservative approach. And then they'll take that approach for all pieces or products within the full manufacturing process. So yeah, it's very much like we are seeing that there's been some issues getting this data. So the adjusted percentage rule is helpful, in fact, that if you have some contractors able to work with you to get this documentation over others, it's a way around going to get this information.
Yeah, and I think what we've seen is like for the structural steel and iron like requirement, like that documentation is pretty standard, especially for, if you're a lot of the federal projects have required that for a while. So that documentation is pretty standard if you're going to pursue domestic content for the manufactured products. Kind of depends on the technology. I think there's for solar, there are like vendors that have they have materials already prepared of like, this is where it was manufactured. So you can meet this requirement. I think for other technologies like geothermal, because there's so many components, it gets a little bit more complicated. So it's really doing, depending on where you fall when you begin construction, if you don't have to meet domestic content and you can just take a haircut, like there's a cost benefit analysis of whether it makes sense. But yeah, I think the biggest part is this manufactured component section can be a little bit more tricky to document depending on how willing your suppliers are to give information to you. I will say for solar and battery, they do have safe harbors right now that if you know that certain components of these systems are US made, that they'll give you like the percentage that they've done a study to show like, oh, the battery cell is, for example, X percentage of the total direct cost. So if you have the battery cells from the US, like you can just take that percentage as without having to get all the extra documentation. But unfortunately for projects like geothermal, we haven't seen a safe harbor come out yet. So it is a little bit more limited on when you can rely on this safe harbor. And then just very quickly, for the phase out, there are a couple exceptions.
Yeah, so so if your product or property is under less than 1 megawatt, you'll be able to not have to do the domestic content. And then if you can prove that if you're going domestically, even though it may be more expensive and the overall construction costs are more than 25%, that can also be another exemption. And then of course, the non-availability, if you can prove that you're not able to actually get the steel, the iron, the manufactured products in the United States, this is another way of going about potentially the exemption of the domestic content phase out. And then just something to mention is that for projects that begin construction before January 1st, 2027, applicable entities can claim an exemption by attaching an attestation. Now, they haven't necessarily provided what has to be included in the attestation, but I'm assuming more information is to come out hopefully in the next couple of years on that before that January 1st, 2027 date.
Yeah, they've given what language you need to use, but they haven't said what substantiation looks like if they were ever to like audit that. So I think it's just making sure you keep sufficient records to show like, you know, you couldn't get a product or some kind of quotes where you're showing that the cost was much more cost prohibitive to get the domestic item versus somewhere else. So that is, I think we were expecting them to issue guidance, but they kind of punted again for a couple more years. So we'll see what happens there. I think that is it.
Excellent. Well, if this was the first time you're learning anything about Inflation Reduction Act, I know there's a lot of information. My head, I think, was swimming the first 2 years of statute coming out, but some of you had heard of it. Hopefully there's some good clarifying information as well. We are very happy. Jen has been very kind from an agenda standpoint, and we've got a little bit of time here to answer any questions if anybody has any.
So for questions, we've got a small enough group. If you want to take yourself off of mute, that's fine, or you can put a question in the chat, or the ever popular raise your hand function will work too. Well, I think people are processing. It is a lot of information to take in.
Yep.
As far as follow-up, Bob, what would be the best process if there's questions afterwards?
Yeah, I know there's a question asking about the slides be available, which I think the answer to that is yes. Right,
Yep,
Jess,
I
we're
can
going to
send
make
those
these
out.
available. Yep. So we'll have those out to folks, and yeah, feel free
Bob,
to.
maybe a question for me. Is there maybe just help bring it together, like an example we're aware of with a state and local government, you know, no names basis that might help resonate for people on the call?
Well, one thing I did want to just emphasize, you know, depending on the size of the projects that you may be contemplating, when you're talking 7- and 8-figure types of projects, that's where the Inflation Reduction Act, despite kind of all the different requirements that we were speaking about, is really going to be financially worth it. You're really talking about, you know, 30 to 40% of your total costs of the project are potentially being covered by the tax credit, and that is obviously very significant if you're talking about a geothermal or even, you know, larger solar project. If you're talking about really small projects, chances are a lot of this, the PWA and the domestic content may not end up applying anyway. So it would be much more simplified in that regard. So I just would encourage you to not be too overwhelmed by all the information. If this is brand new, but I think that 30 to 40% possibility here with covering the costs is really, I think, the biggest takeaway as you're thinking about the budgeting and financing aspect of the project.
And I think we've seen like a lot of geothermal up in the New England area with like new schools, campuses, and then, you know, solar, rooftop solar has, you know, been around for a while, but, you know, we see a lot of that. And then the EV charging stations. I think the only thing with the EV charging stations is you kind of have to do a cost benefit analysis if it's worth it to have track like all the PWA stuff to get the 30% credit, or if it's just going to be like a very quick, simple installation. If you just run with the 6% credit, take it on the return and, you know, are done. So it's kind of just understanding all this stuff requires kind of a cost benefit analysis up front to make sure, you know, what path you want to go down.
And I'll also mention again just the wastewater opportunity. There are technologies out there that are converting wastewater to energy, and those are very much also eligible for the credits. That tends to be a lot lesser known. With wastewater, we tend to think much more about the geothermal and solar, certainly. So keep that in mind as well.
I think my last point is it's okay if you're getting like other grant funding for a project. Like we've seen like a lot of like EV charging stations. There might be a state program or, you know, a federal program that it's okay to use both. You just have to make sure that the tax credit plus your grant doesn't exceed the total cost you spend. If not, there might be a slight haircut. And for most projects, I don't see that. EV chargers, sometimes the grant's so large that it could exceed that, but for other projects, usually the CapEx is big enough that it's not gonna approach that amount.
Good problem to have if you've got grants and tax credits exceeding the cost.
Absolutely. All right. Last call on questions. Oh, slides, yeah. All right. Well, I would love to offer up more opportunity to talk with the folks at EY who will be at our convention coming up on March 20th, coming quickly. So if you haven't already registered, please go ahead and do that on our website. Thank you, Ernst & Young, for being here and sharing this important information with our constituencies. I think that, you know, any savings is good, and this is a new area that many haven't delved into yet. So I appreciate your time and your partnership. So thanks so much.
Yes, thanks so much, Jen. Good to talk to everyone. Have a great day.
Take care.
Yeah.
Yeah.